and welcome to Quarterly Q&A with the advisors at Owens Estate and Wealth. My name is Sonia Jenkins. I'm an advisor here at Owens, and I'm joined with Dylan Blomgren and Peter Ketchand to give you the latest quarterly update. We'll start with a high-level overview with the U.S. Recession dashboard, kind of looking back at what the signals have been showing us over the last 3 quarters. It's interesting to note that as of June 30th, the most recent quarter end, all of the signals are showing expansionary with the exception of job sentiment, how corporations feel about hiring. And looking back over previous quarters, that's a definite improvement to the economic indicators as a whole. Pushing that further back to look at these current indications relative to major events in the market, you can see, in former recessions, the signals were vastly different. We're seeing a lot of indications for positivity within the economy overall. Digging into that a little bit deeper, what's driving that? Well, it's really been interesting to see that the 3-month moving average in the labor market has really seen a positive indication. And you can imagine, while job sentiment is still showing cautionary or even recessionary in the signals, the labor market itself on a rolling 3-month average is definitely improving. So it'll be really interesting when we do our next quarterly update to see where that recessionary signal is trending to when we do this again in October. But definitely when you're looking at what drives the economy as a whole, the labor market is a very relevant and important component to that. So seeing this positive upswing in 3-month moving averages of employment is definitely a positive indication for that one recessionary signal that we see. Pushing that out further of looking at like households and how they're feeling. So sentiment is a really big component to how the economy operates, because how we feel about certain things definitely dictates how we use our money. And in recent months, we've seen a definite decline in how households are feeling about their future debt repayments. And so we're seeing a decline in the chance of missing a minimum debt payment over the last 3 months. So that's a really good indication that households are feeling a little bit less stressed. Now, that could be because we saw a really nice, healthy refund from tax returns for 2025. That was expected to be a positive indication for the first half of 2026, and that may be very well playing into why households have been feeling less worried about being able to make their debt repayments.
Though I just like to point out that just because they're feeling less worried doesn't mean they're necessarily feeling good.
It's true, right? Less worry doesn't always mean positive. It just maybe means less negative. So that's a very valid point. Kind of pushing that further, looking at consumer finances, not a lot of changes since the last quarterly update, with the exception of student loan delinquencies. That's kind of been an indication we've been following pretty closely. Once we went into the COVID era where there was a definitive pause on repayments, you can see that really big drop on that orange line in the lower bottom corner, where there was no delinquencies. And then once repayments came back into play, it's a huge spike into flows into early delinquencies in the student loan provisions. But we've also now seen a definitive drop. So again, another component that will be really interesting to follow. As far as balance sheets are concerned and liabilities, student loans only make about 9% of the liabilities in total for this particular, screen that we're looking at, but it is meaningful. It's definitely meaningful. Other early delinquencies for auto loans, credit cards, and mortgages kind of trending along, average. They're not wildly ramping up. So in our opinion, that's a very good indication that at least for right now, consumers are being able to maintain their own liabilities. We're not seeing a huge increase into delinquencies there. Pushing forward into the federal level of looking at the federal finances, again, not a huge change from the prior quarter's update. We are still battling with a deficit that's nearing $2 trillion, not an unmeaningful amount, not a big shift in how the budget is being allocated, where spending is being targeted towards. There's a lot of discussion about it, but we don't see a lot of actual traction in how they're changing their spending allocations. The federal deficit, interest payments, all of those seem to be trending right along where we would expect them to be. But the accumulated deficits are definitely something that we're keeping an eye on, because that projected upward trend is not something that we like to see in that. It would be nice to see that trend start to flatten out a little bit. But as of right now, the forecast is still pretty strong with the higher interest rate environments that we're in. And then finally, this was just kind of something that I thought was pretty interesting when you're looking at the economy as a whole, when you're talking about the labor market and where things going, and then all of the discussion around AI. There's a lot of concern that AI is going to have a negative impact on the labor market as a whole, that there's going to be less jobs available. And I think that the Javon's paradox kind of brings to light some interesting information. It was first brought about by William Stanley Javon back in 1865. And when he first studied it, it was more relevant to making coal more efficient to use. And what they actually found was that as coal became more efficient, they actually used more coal. And so it created more demand rather than less. And this particular slide is kind of pushing it forward to a more present day relevancy of, when Microsoft brought to the table Excel macros. And in accounting and bookkeeping, it made their jobs a whole lot easier. And while right at the beginning, there was a dip in employment that they thought, okay, well, we need less bodies to do the same amount of work. What they realized was, well, actually, we can hire more people and get even more done with the efficiencies. And so it's really interesting to kind of see how that kind of pushes forward. And I think that there's a very real possibility that with many of the AI oriented improvements in the labor market, that you could see that, right? There may be a temporary pullback in employment in specific sectors as they start to embrace AI oriented efficiencies, but then ultimately an uptick in employment when they realize not only can we use AI to be efficient, but we can keep the same level of employment or even more and get all the more done in the same or shorter amount of time. So when we look at, where the economy sits as a whole, kind of doing that high level overview before we really start to dig in, those are the things that I would look at is, well, economic indications, with the exception of job sentiment, are expansionary. They're positive. Those are good things that drive the economy forward. When we're looking at households, they're definitely seeming less worried, not necessarily positive, to Peter's point, but less worried than they were, in previous quarters, which is good. And then looking forward into, but what about the labor market with the continued development of AI? What could that look like? So all in all, right now, where we sit, we believe we're in a strong economic position, but I'm going to pass the baton over to Dylan. He's going to dig in a little bit further and kind of go into it from a stock market perspective.
Thank you, Sonia. For those of you who missed our last quarterly Q&A, I want to go over the top 10 companies by decade going back to 1985, because there has been some recent changes that are relevant. If we look back just 20 years, back to 2005, there's only one company that is still in it. We've seen lots of changes every decade. Since our last quarterly Q&A, there's actually been two changes, adding Eli Lilly here and Micron. But that won't be for long now that we have the SpaceX IPO, and we're going to see some new changes as it comes. So that being said, those years leading up to joining the top 10, you're historically outpacing the rest of the S&P 500. Once you hit that benchmark, there tends to be a huge drop off. Once again, showing the dot-com darlings and where they are today. So showing in the year 2000, the 10 largest companies in the S&P 500, only 2 of them have outpaced the S&P 500, and not a single one of them has outpaced the S&P 500 in the equal weight version. That being said, I know we've heard a lot about the Magnificent Seven over the last 10 years, and for good reason. They have outpaced the rest of the S&P 500 for a long time, especially since COVID. Now, we think that there might be some changes coming to US large cap and US tech. There may be some opportunities as well. Year to date, only one company from the Mag 7 has actually outpaced the S&P 500. So where are there some opportunities right now? So currently we see that small cap and mid cap companies are actually on sale compared to US large cap. Currently, small cap and mid cap are slightly more expensive than the historical average at 16.4 times earnings compared to the historical average of 15.9, but that's significantly less than the rest of the S&P 500. And going forward even further, global valuations are even more attractive than small cap and large cap at 14 times earnings compared to the historical average of 13.2 times earnings. Once again, historically less than the S&P 500. And as we get to emerging markets are actually cheaper than the historical average. So we see the most opportunity going forward in emerging markets. That doesn't mean to jump into emerging markets or to US small cap head first. That just means that diversification is going to play a major role going forward in the market. Last one here, we have the global leadership cycles. This is showing that the US versus international outperformance, and US has outperformed international markets really since 08. So going forward, will we see some changes? Maybe. When will that happen? Who's to know? But we are definitely seeing the beginnings of a shift in global markets.
And would you say that, kind of looking at that from a philosophical standpoint, and when you just reflect back on those slides before, where both, international global valuations from a price to earnings ratio are lower relative to the S&P 500, as well as emerging markets, those are things that could turn the tide and really make the shift away from the U.S., leadership in the markets push to a more global standpoint.
Absolutely. That's a great point, Sonia.
Yeah, that's why we got the question mark at the end of this slide.
I love that there's a question mark because that's so appropriate.
Yeah, I think they should be at the end of every slide.
All right, with that, I'm going to turn it over to Peter.
Most of the information in the first two sections of this update have been positive. The economy, it looks mostly good from a broad standpoint, as do a lot of the market opportunities. So in this slide, we see that consumer confidence is very low if we look at the end of the slide. And that begs the question of, if so many things are going well, why do we have this low consumer confidence number? And you probably have heard this in the news, or this term, but the term is the K-shaped economy, where half the economy is doing really well and then half the economy is being left behind. And so this is what we're looking at here with these graphs. We have the labor compensation versus corporate profits, which shows that corporate profits are increasing. So asset owners and people making money off those companies are doing better. And then labor compensation as a percentage of income is decreasing. So people who are making their money off their income are doing worse on average. We can also see, because they're breaking up total pre-tax income and spending into cohorts, that the bottom 60% here, the bottom 60% of people are spending more than their share of the pre-tax income, versus the top 40%, which are even, or the top 20%, which are doing better. So that creates a situation where a majority of the consumers are not feeling bad about themselves, even though the total economy is still benefiting. This oil in the economy slide is specifically, we're looking at the same cohorts for our purposes for this discussion. The consumer expenditure on energy is not high on average, but you can see the bottom 20%, it's at 17, almost 18% of their income. So the energy fluctuations and energy increases are highly negative for a good group of the economy, which creates this K-shaped economy and creates this sense that things are not going well, even if they are going well for a relatively large cohort, and they're going well on average. With that, this K-shaped economy might produce a longer term trend where there is some more negative impacts on the economy. Additionally, we believe that there are some other longer term issues that can also potentially be a drag on the economy and therefore the markets as well. The first of that is we have actually, for the first time in a long time, definitely in the scope of this graph, a negative labor outlook, i.e. there will be less laborers in the next 5 years than today. And as you can see from other aspects of this chart, GDP is basically productivity plus labor increase. So if the labor decreases, the productivity will have to increase greatly to keep us at the long-term average of 2%. So we could see some definitely negative ramifications if productivity does not account for that labor drop, or we don't make policy changes to, increase our available labor. A second thing on this chart is the capital spending components, which shows that much of the capital spending is on intellectual property, which is important, but there is an underspend on physical property, physical capital expenditures, which help companies' profitability, but at some point the bill will come due on that. So that's from a corporate side. And then secondarily, this is infrastructure investment needs on a government or societal outlook. And you can see that we are, in America, we have the data to show that we're underspending significantly on our infrastructure. And then the infrastructure investment needs by region just shows that we need $100 trillion globally of infrastructure spend, which, assuming other countries are in line with our level of underspending, that's $50 trillion that the world is going to have to come up with to rebuild, maintain, and expand infrastructure, which could significantly impact the long-term outlook for our capital markets. And finally, I like this slide because it reminds us, as the midterms are coming up, not to be overly concerned with the outcomes of the elections, as there is generally very little relation to the stock market and which party is in power.
I think that's a fascinating slide to put into perspective, because I think we all have our own feelings about administrations, and they definitely impact how we feel about the market and the economy as a whole. So having a little bit of unbiased perspective to look backwards and see that is, I think, pretty fascinating as we head into the midterm elections.
Yes, I mean, everybody feels strongly about their political positions and their policy preferences, but in the end, while those are important, they are generally not highly impactful to our investing outlook.
Well, thank you so much for joining us today. We hope that you enjoyed this presentation that we put together for you. We find that these quarterly Q&As are a great opportunity for our clients and their friends to hear what we're thinking here at Owens Estate and Wealth. It's an ever-evolving environment that we live in, and nothing is ever stagnant. So these updates are nice because as things shift, we have an opportunity to kind of touch base and give you a little insight into what we're thinking here at the firm. Again, thank you for joining us. We hope that we will see you either in person or online again in the future.